Okay, so you want to buy a shopping mall. Here's the pitch nobody tells you. Fill an empty building with stores, and every single one of them pays you rent just for the privilege of standing there. Sounds like the easiest money in America, right? Wrong. Malls are one of the strangest, riskiest bets in all of finance, and the story of how they make money and how they quietly die will change the way you look at every mall you've ever walked through. So let's talk numbers, contracts, and one clause buried in almost every lease that can bring the whole thing down. Building a mall from scratch, land, concrete, wiring, parking, permits can run into the hundreds of millions before a single shopper walks in. Buying an existing mall is cheaper, but not all malls are equal. A Class A anchor with a luxury anchor and a waiting list of brands can trade for $1 billion because its income is stable. Drop a tier or two, and some malls have sold for a fraction of what it costs to build them because the price tag isn't really about the building, it's a bet on the neighborhood around it. And even after you close the deal, there's a hidden bill waiting. Anchor stores often sign their leases decades ago at rent so low it's almost a rounding error, and you're stuck with that deal for years. Add in leaky roofs, aging HVAC systems, and cracked parking lots, and your first winter as a mall owner can get expensive fast. Most malls aren't owned like a house either. They're owned through REITs, real estate investment trusts, companies required by law to pay out nearly all their profit to shareholders in exchange for skipping corporate tax. That's why an everyday investor can own a slice of a mall in Washington, D.C. for the price of a coffee without ever touching a broken escalator or a leaking roof. Money flows in 3 layers. Base rent every tenant pays no matter what. Percentage rent once big stores cross a sales threshold, and maintenance fees quietly passed back onto tenants for cleaning, lighting, and upkeep. But here's the trap door. Almost every mall lease has a co-tenancy clause. If a major anchor store closes, smaller shops nearby are allowed to pay less rent or leave entirely. One empty department store can trigger a domino effect. Foot traffic drops, the next anchor loses sales, more tenants leave, and a thriving mall can hollow out in a few short years. It's rarely one dramatic crash, it's a slow unraveling, clause by clause. And yet, dead malls don't always stay dead. Old mall shells across America have become apartments, warehouses, medical centers, even data centers, because the land underneath is often more valuable than the retail ever was. So, would you buy one? Owning a mall isn't really a bet on stores, it's a bet on people, contracts, and a neighborhood's future. Get it right, and it's one of the steadiest income machines in finance. Get it wrong, and you're stuck holding an empty building. Either way, now you know the real economics behind every mall you've ever walked through, and that's a little bit of money knowledge nobody can ever take away from you. Understanding how finance actually works one building at a time is how you start spotting opportunities everyone else walks straight past. So, if this helped connect the dots, hit subscribe, drop a comment on whether you'd bet on the mall or the land underneath it, and share this with someone who loves talking money as much as you do. See you in the next one, and here's to smarter bets ahead. Don't forget to like and subscribe.